Hello value investors, thank you for joining me. Today I want to talk about how to value the correct multiple on a stock. If you're new to the channel, please subscribe now so you can get my next value installment. Also, don't forget to check out my marketplace on Seeking Alpha. The marketplace is called Deep Value Returns. You can see which stocks I own and why, with a balanced argument for the stocks that I own. So let's get started. When it comes to figuring out what kind of multiple to assert to a company, it very much depends on a few factors. Number one factor that's very, very important, how locked in that customer is. Is that customer buying something on a very discretionary basis and not likely to buy again from you ever? That's one sort of multiple, because that's a very difficult business model. Another one is that the business has a very strong competitive advantage and you kind of have to go through it. So it's like a toll bridge. You can think of something like Microsoft. That's a different type of multiple. Then you have a different type of business that the customer is locked in. There is a contract. You can think of your SaaS businesses. So the customer is kind of locked in. That's a new paradigm, but this customer is locked in. So that's a different type of multiple. But the question you should really be trying to get to is this business going to be more relevant over the next 5-10 years? If you can figure that out, you're in the driving seat. If you can't figure that out, it's going to be difficult to get this right. So, when it comes to valuing a business, even let's say something like a toll bridge, it's going to be growing, hopefully, alongside inflation or slightly better. It's not a very high growth, so you're not going to pay a very large multiple. On the other side of the equation, you've got a business, for example, a software business that is asset light. So it's going to have a higher multiple. You might be looking at approximately, let's say, an 8x sales multiple. Okay? Then you have a business, like a SaaS business, that is growing fast. Customer retention is very low. And you're going to probably give it around a 10 or 12. In a few cases, you could justify a higher multiple, let's say 17 to 20, dare I say. But those businesses are very few and far between, and very many of those businesses are just really just going off the narrative of each other, but when you actually dig in, it's not really worthy of getting that 20 multiple. But let's take a step back. Considering the earnings power growth of that company. So I'll give you an example. Let's talk about Coca-Cola. So Coca-Cola should be worth more on the EPS level, let's say in 5 years' time. It's a business, Buffett always talks about it. It's a strong business, strong franchise. It should. But ultimately, if you look back over the last 5 years, it's kind of hovered around $45 a share. Now, you can say, oh, yeah, I'm getting the dividend, I'm quite happy with that. But ultimately, is it worth the risk after 5 years? Because it's kind of was doing relatively well in 2019, and then in 2020, it just kind of like, overnight pretty much was down like 40%. Not quite, but it's very close to that. So it's a lot to do with perception, and it's difficult to value business if there isn't a strong argument. You have to have a very strong argument that that business is going to be more profitable. Because what you really want in the ideal scenario is to pick out a company that is misunderstood, and over a period of, let's say, 3 quarters a year, there's a change in perception. So you buy something that has either negative sentiment or investors are not particularly enthusiastic about it, and you understand something, and you can see that the business, for example, is going to be doing better over the next 5 years, and you get that in, and over the next 12 months there's a change in sentiment, so the multiple increases. That's really a very, very rewarding investment opportunity, but it's very, very difficult to do. It can be done, but I wouldn't be willing to bet a lot on those types of opportunities because they're rare. An even slightly better opportunity is when that business is highly shorted. Let's say approximately 40% of the float is shorted. You understand the market is very, very negative, and even if you kind of buy it and you hold in, let's say, a 50% loss, and there's a change in sentiment over a period of a quarter, and the short squeezes out a lot of the short sellers, and there's a change in sentiment, man, that's like, you get one of those in a year and you're sorted. You're pretty much sorted for that year. It does happen. It's a lot of hard work, but those are difficult things to do. What I will say is that it needs to be a very, very compelling idea, which brings me to the next point. When do you get out of this sort of business? So in my videos, I always say, write down before you buy 3 reasons on a piece of paper of why you want to buy. Because if you don't have a strong exit strategy in mind before you make the purchase, it's going to be very, very difficult to, you holding that stock for about a year, the stock hasn't really gone anywhere, or worse still, the stock is down slightly, and you're kind of like, shall I wait and see how things turn out? So that's very, very difficult. That's why I say the preparation is half of the sell. So if you come in prepared, that's it. You sort it, because you've done like, it's like 80% of the whole strategy is coming in on preparation, because afterwards it's if you're well prepared, it's easier. So you need to visualize in your mind what is an exit strategy. So I write that down a lot in my mind. I write down on my marketplace that what I'm trying to look at. Another sort of opportunity that can lead to a re-rating or the multiple to expand is when within the total revenue that the company makes, there is a segment that is doing better. So a business that you may be very familiar with, which I don't have any position, so free to talk about, is something like Apple. So starting 2016, CEO Tim Cook talks about Apple services is going to double its revenue by 2020, and it has done that. But it was highlighting that opportunity for a long time to investors. Pretty much every interview, look, 2016, 2017, 2018, just talking about it constantly. Services, 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 just highlighting that. So I'm just saying, if you can get in an opportunity where one of the segments is growing quite well, has very high margins, and the rest of the business is kind of like, in time, that, let's say, that more profitable or higher growth segment can be better understood by the market. So if you can get in before that, that's really, really attractive. That can be quite attractive. It can even be that it is an old segment, but something has changed slightly. Maybe the business has gone slightly more online, maybe it's got more cloud-based, so it can remove a lot of the SG&A. Maybe it's outsourced, something can be slightly different. So if you follow a lot of businesses and you can see, okay, this would be a bit difficult to understand, or better still, it's not difficult, but nobody's really following this business in that way. For example, I'll give you the example of Apple. Apple is the most followed business in the world. And Tim Cook, for about 4 years, is going on any media channel, is talking about it ad nauseum. So this has the whole of Wall Street, the whole United States is following this business. Europe, Malaysia, China, everyone is following Apple. But it took a lot of convincing. And now obviously you look at the multiple that people are awarding to Apple, is very, very high multiples, a very large confidence there that Apple will do well now. So that's what I'm trying to say. If you can just understand that change in sentiment. So what is the right multiple for a stock? It's very, very difficult to give an answer. That some of the people write to me in the comment section, okay, Michael, have you looked at the stock? What kind of multiple can I get for this stock? And that's very, very difficult to know. There's not a precise answer. It's not just a tick box exercise. What I will say is 2 things. Number 1, if you work hard on the preparation, You write that down, stick to your plan. Okay? Number 2, if you follow a lot of companies, follow the peer groups. If you follow the peer groups, try to understand a little bit of what is the advantage or disadvantage. So I follow a certain e-commerce business, and you can just follow some of the peers, and you can see, okay, this company has very high margins, the peers are not doing so well, but the peers are more highly valued, and this company that I'm looking at is cheaper, so there could be an opportunity for my smaller business in time to kind of get some validation for the market to see it in a different light. Now, this is a lot of practice, and what I think is very important is to come with the mindset of not being a weekend investor, but putting the work in all the time, having a passion for investing. It really, really helps, because the more businesses and mental models, that multidisciplinary approach that Charlie Munger always talks about, if you understand so many more business models, it becomes quite easy to grasp when something is slightly mispriced and to kind of have an opportunity. Okay, I followed this business for a long time, I know that played out well, so this business could play out similarly. It is possible. So that comes through a lot of practice. And I think that just by looking at the peers, you get a real familiarity. I often talk about businesses like buying a home. The amount of due diligence you do towards buying your family house is the same level of due diligence that is necessary for buying stock, because it's a commitment. You may be with that stock for about 3 years. It's a very large commitment. So you would look at the neighbors, you would look at the whole neighborhood, you try to get an understanding of why your home is cheaper than the one next door. It might not be cheaper, but just trying to get a feel for what is happening in that community. So the same with the business. That's the level of work that the person needs to put in ultimately. So I hope you found this video useful. Don't forget to check out my marketplace on Seeking Alpha, Deep Value Returns. Find out which stocks I own. Do a free trial there. See you soon.